Hey everybody, welcome back. This is the pre-market prep show brought to you by Charles Schwab. Just Ask Chuck. This is Kyle Bazzi sitting in for Joel L. Conan with my co-host Dennis SPY because I got a dick, and we have a great guest to bring you this morning, Mr. Kevin McPartland, head of market structure and technology research at Greenwich Associates. Good morning, Kevin.
Good morning. How are you guys doing today?
Not too bad. I first want to talk about, I saw on your Twitter account you have financial markets, fintech, craft beer, and cycling. So we're already going to get along right off the bat here.
Perfect,
Now,
perfect.
I saw a report come from you and was reading it this morning talking about changes in U.S. corporate bond market evolution, not revolution. Can you talk about that paper?
Yeah, sure, absolutely. So there's a couple of findings in there. One of the key things that we focused on was the growth of electronic trading in the corporate bond market. I think there's a lot of sort of view into bonds that why don't bonds trade more like stocks? I think there's at least one simple explanation before we start to get into any more nitty-gritty detail. If we think about the U.S. stock market, there's a couple of thousand issues. So if we think about IBM, for example, there's one common stock for IBM. If you want to buy it, you want to sell it. Everybody's talking about the same IBM. If we look at the corporate bond market for IBM, there could be as many as 50 different IBM bonds that are currently out there and active. So if you have one IBM bond you want to sell, the likelihood that there's someone else out there that wants to buy the exact same IBM bond is pretty unlikely. So it makes it really, really tough to match those buyers and sellers. Now, technology certainly can help with that in the long run. In fact, in the retail market for corporate bonds, there is actually a good amount of electronic trading going on, upwards of 80 or 90%, which is fantastic and a huge growth over the last bunch of years. But when we start to talk about institutional trades, the banks trading with the big asset managers, when we're talking trades with notional values over $5 million, it starts to get a lot thinner. We found that it's really only about 15, 16% of trades are done electronically. So, there's certainly some ways to go there. We've seen some progress, but it's the market's it's a tough one to move on to the screen like we've seen happen in other markets.
We've talked about the bond market for years, trying to bring more transparency to it. And how do we do that then, Kevin? Like, how do we get more transparency in the bond market if everything's just done off exchange?
Yeah, no, it's a tough one. I mean, on one hand, we had trace reporting sort of brought into play, over a decade ago, right? So every bond trade is actually reported. There's a delay; it's 15 minutes later. So there's, in some ways, there's more transparency to bond trades than there are for some other over-the-counter, traded products out there. That said, it takes a little bit of work to sift through that data and make some use of it. The other problem is, and this is sort of true in most any, illiquid market, maybe the top 5 or 10% of bonds are trading enough where you can look back and see a recent price that'll give you an idea of what you should be paying today. But in bond markets, especially when you're kind of looking at the bottom end or high yield issues, things that just don't trade. In some cases, maybe they didn't trade. The last time they traded was a month ago. So how do we know what the price is today? It all becomes theoretical, in which case, especially for your sort of professional trader at home, like I said, when you're buying the smaller size that we call micro lot trades, it's a lot harder to really put your finger on exactly what that bond should be worth, because we really are sort of marking to model. We see some pretty cool technologies that are sort of in real time, theoretically pricing these bonds, telling you what they should be worth. But like most anything, you could look up. I remember as a kid looking up what a baseball card was worth in those big books, right? But it's really only worth what somebody's willing to pay for it. And in some ways, the bond market's not terribly different.
So with the bond market and trying to bring a little bit of transparency there, let's swing it over to equities here, because we've kind of had a little bit of the opposite evolution happening in equities over the last 3 or 4 years, where most of the equity trading was done on the exchanges, and now we're seeing 40% of our equity trading going off exchange. So while the bonds were trying to bring some transparency and light to the bond market, our equity markets appear to be going dark. What are your thoughts there, Kevin?
Yeah, I mean, I think when that started in equities, the reason it started, and I think it probably, to speak, this is arguable, but to some extent this goes back to LiquidNet. right, when they came on the scene, and they would look to basically take two investors who both had larger size orders that they were trying to trade and allow them to find each other, right? So if you've got, sort of take your pick, but the Boston asset manager on one side and the New York asset manager on the other, one wanted to sell, 20,000 shares, the other wanted to buy, they can match them off in the middle without, having to go to a traditional exchange that might have impacted the price, as the market saw that they were looking to, buy and sell bigger blocks. And this sort of all came on the scene as the average order size on the exchanges was going down and down and down. So I think that was the original intent. You've got it's almost like the wholesale market, right? You've got bigger size orders you want to do, so let's find a way to put those together. Now over time, and I think that model is still a great model. I think we still want to encourage that. But now we've gotten to a place where you're seeing the average order size on a lot of these sort of dark pools and ATS has become smaller and smaller as well, which at least in my opinion, that sort of defeated the original purpose. Right? The purpose was to sort of match off and help people get these larger orders done. There's the great parallel to the bond market, right? This is why this is the least electronic part of the bond market are these bigger trades. If we look, and this is something we talked about in our research report you mentioned, but if we sort of start with the smallest trades, those that are under $100,000 in notional size, it's very, very electronic. And as the trades get bigger and bigger and bigger, the amount of electronic trading gets smaller and smaller and smaller, which again is not terribly crazy. I try to think about these things in very simple ways. You're going to make these days, you can buy almost anything on Amazon, but you're not going to buy a house, you're not going to buy a car, right? When you get to things that are bigger and more complicated, you still want to talk to somebody, you still want to go touch it and feel it. And I think the financial markets largely work the same way.
But with all these small trades, going back to the equities, with all these small 100, 200 share retail trades now being pushed off exchange here, what does that do for the public price discovery? What does that do? Like, let's take some small cap stock. And you see this really prevalent in a lot of the small caps where you see 60 or 70% of the trading off exchange. What does that do to the market maker on the exchange who's posting a bid, who's sitting out there, displaying his intentions? And then when we allow these other off exchange market makers to simply match their price, does that not discourage those original participants, the ones that are actually providing the liquidity, from placing those bids in the first place?
Yeah, I mean, I can't really disagree with you on that point, right? It's not a small fee to act as a market maker, to be able to make those prices, to be able to stand on the bid and the offer and keep those markets moving and liquid and balanced, right? That's a service that a lot of these firms are providing to the marketplace. And I think what people see, and maybe I should or shouldn't be drawing the parallels between bonds and fixed income, but I think the point is that this is not just an equities thing. This is happening across the board. It's almost like if you're taking those prices and using them elsewhere, you can see that as a little bit taking advantage of a service that's being provided, but then not allowing those service providers to be compensated for what they're doing. Which then over time could discourage them from providing the service, which then hurts overall market liquidity. I mean, I think this is we've talked a lot about in other OTC markets, not just bonds, sort of the idea of letting clients trade with one another, and that if you take those dealers out of the middle, the dealers are the price makers, right? The investors aren't the price makers. I know when I go online and I buy and sell stock, I'm not saying this is what I think it should be worth. I'm sort of looking at where the market is, and maybe you put a limit order in and you're a couple of pennies in either direction, but you're not the price maker. The market makers are the price makers, and we need them there. So if we sort of kind of take advantage of that to too much of an extent, that could, I think you're right. I think that could in the end hurt everybody.
And isn't that like in the small caps, like we're talking about doing the tick size pilot, and we're trying to find, how to improve this market. We're going to go on, we're going to widen the tick, trying to better compensate those dealers. But if we just continue to allow price matching, if we just continue to allow the off exchange guy, the dark guy, to just match the price, is the tick size pilot even going to help?
It's a time. I mean, this is one, and this is one of the things I like about the SEC's approach here is that they're treating it as a pilot and very, very specifically show we're going to go through this, we're going to take all this data, and then we're going to make all the data available to everybody and let the market take a look and see if we think this helped. I like the idea, and I've always liked the idea of incentivizing the behavior that we want rather than, putting down hard regulations to require a certain behavior, right? And I think that sort of more facilitates sort of the free market thinking and the way that this is the U.S., this is the way we operate. So I like that approach. I like that they're trying to change the market in such a way that it maybe incentivizes more people to come into a place or provide more liquidity where we haven't had any before. But yeah, I mean, exactly how you keep that balance just right. Because like I said, I think the value of allowing these big institutions to be able to get their large orders done with less market impact and such is a good thing. And we have to always remember that when we talk about large institutional asset managers trying to do orders, the majority of the money that they're investing is retail money, right? It's 401ks, it's IRAs, it's pension money. So this is not a big institution versus the retail thing, right? This is the big institutions that are investing for retail. But yeah, I mean, we'll have to see how the data plays out. I'm a research analyst, right? I like to see the data and make my conclusions based on what the data shows. So we'll have to give it a couple of months and see what pans out.
So Kevin, we always talk about, and this is a big topic not only just on a show but on Benzinga as a whole, the retail trader and investor. And I get this question all the time from our readers and users. What does that mean for us? We're obviously not moving the big blocks. This market structure has changed so drastically over the last 10 years and especially the last 3 years. What does that mean for us? Does that mean we need to go through a professional to, not get taken advantage of?
Yeah, I think I always still tend to lean back to the argument that, as a whole, the retail investor today is much better off than they were 10, 20 years ago, right? I mean, just the amount of data that's available, the amount of research that's available, the cost of trading has gone down. Even the technology innovation, the systems that you can run, on your laptop in your basement, and the amount of data that you can see and the charting, and there's just so much available that would have seemed crazy 15 years ago. Really, it's good for the retail investor. And we can argue about whether or not the Michael Lewis book 6 months ago was a good or a bad thing for the market, but the positive I think that came out of that was it did reinvigorate this market structure discussion in equities. And we always should be trying to make the markets better and more efficient, and really thinking about how they work and what's good and what's bad and what we should encourage and what we should discourage. So all in all, I think that's a good thing. But the markets are complicated. If I had my way, and I think I've said this before, but if I had my way, we would, let's just shut everything down for a month and throw everybody in a room and sit down and figure out how to start the rules, write the rules again from scratch, knowing everything we know today, and then start the markets up again. Obviously that's never going to happen. It's a pipe dream, so we need to work with what we have. But yeah, the retail investor's better off today than they ever were before, but the markets are certainly more complicated as well.
Isn't that the biggest problem, though, is that they're so complex that the little guy doesn't even stand a chance to understand any of it? I mean, even the stuff we're talking about here today, it's probably going over a lot of people's heads. I mean, you can talk about access fees, you can talk about order routing, you can talk about fair dissemination of market data, which BlackRock was talking about last week, and giving their recommendations. But all this just goes over the little guy's head, and the little guy just wants to know that they're on a level playing field. That's what they really want to know, and that's what Michael Lewis was saying that they weren't. Michael Lewis was saying that they weren't on a level playing field. What's your thoughts here, Kevin? Is the little guy, is grandma on a level playing field with the big high-frequency trading firms?
So if you're a professional trader at home and you're actively trading every day, that's a pretty tough thing to do these days, right? And I think if there's any unlevelness, that's probably where it is. If you're grandma, if it's your 401k, if it's your long-term retirement, your college investing, sort of any of that more traditional long-term investing, I don't think so. I don't think it's a problem, right? Because it's not just down to the commissions on an individual trade, but even within the mutual funds and the ETFs that you're buying, the fees are so low from where they were. And having spent some time on the buy side and seeing the work that goes into managing these mutual funds, it's it's amazing that fees have gotten so low. Even for some actively managed funds, it's amazing that these fees have gotten so low. So, I feel like today for less than 1% in fees, you're getting access to these sort of top-notch money managers to manage your retirement portfolio. It's really pretty amazing. So I think it's important to draw the line there between like I said, the active home trader and the long-term investor, and I think that's where the difference really shows.
So it sounds like you would kind of recommend to the little home person or grandma that they try not to sit here and scalp there for pennies, because that's putting them in direct competition with the high frequency traders. But if they just look out a little bit longer term, lengthen the time horizon, then they'll be in better shape.
Yeah, absolutely. Once I got a little older, I had kids. Now I just do what they tell you. I make sure you stick a certain amount of money in all your retirement accounts every month. Don't try to time it. Just invest for the long term, and history tells us we're going to be better off that way.
Okay. So just one other thing here, just before we're going to complicate it a little bit here again, but I was reading BlackRock recommendations there just from last week, and they were saying to reduce exchange access fees. This is a big talk, the whole maker-taker, and it actually complicates a lot of things. Isn't that maybe potentially the source of why this market is so complicated, because of these access fees? And what we're talking about there, if you don't understand at home, is that when you have a limit order out there, that limit order, the trader providing that order out there is actually paid a rebate, and the person that is taking that order is actually charged a fee. And these access fees can make everything very complicated, because you get a lot of high frequency traders that are looking just to capture these fees. You have retail brokers that don't want to route to the exchanges because they are charged these fees if you're using market orders. Isn't that maybe the source of why this market is so complicated?
Yeah, I mean, it certainly skewed the incentives in the long run. I think the original reason, and this is, I obviously read Flash Boys, and I was kind of okay with it until we got to the point about Michael Lewis pointing out why he thought Maker-Taker was created, and that's sort of where I got a little turned off. Maker-Taker was originally was a method to help startups to try to attract liquidity from, at the time, sort of, I guess you would say, the exchange duopoly, right? This allowed competition, this allowed innovation, this brought us to guys like Bats and Direct Edge that we have today that are so big and innovative in the marketplace, and caused the other guys to step up their game, quite frankly. So I think that was good, right? That was it was pretty tough to take share from the NYSE at that time, and this was one way that they were sort of encouraging liquidity onto the exchange. One of the toughest things that any electronic marketplace has to do these days, even an existing exchange that tries to launch a new product, for example, is you need to bring on the liquidity to create more liquidity. It's very, very difficult. So that was the original reason. Let's incentivize, as we talked about earlier with the tick pilot, right? Let's incentivize people to come on and start trading here, so we can see if we can build the critical mass. Has it gone a little too far? Possibly. Again, I'm not sure banning it is the right thing. But maybe there needs to be more incentives or other ways to rethink this model at this point. I mean, the only other thing I could think of, right, is and I think to some extent that the dealers probably see this. I'm less sure if all of the investors would see this, but when you're looking at a bid or an offer on the screen and you're trying to decide where to trade, is you really want to see sort of what's the all-in cost of this trade, right? What is this really going to cost me? Because maybe the take fee that you have to pay is still going to make that order be cheaper here, rather than going over here where you might get a rebate, but it's still going to be more expensive. So, I mean, I think that would go a long way to help. And these are tools that I think institutional investors have that maybe the retail investors don't, and maybe they should. Maybe that's something what we can think about.
All right, everybody. Well, that is Kevin McPartland, Head of Market Structure and Technology Research at Greenwich Associates. Kevin, it is a pleasure having you on. We look forward to having you on again in the future.
Sounds great. Great talking to you guys. Have a nice day.
All right, everybody.
Thanks, Kevin.